Hello, best ever listeners, and welcome back to another episode of the Actively Passive Investing Show. As always, I'm Theo Hicks, speaking today with Travis Watts. Travis, how you doing today?
Hey Theo, I'm doing great. Let's rock and roll.
So today we are going to be talking about capital stacks and waterfalls. So a little bit more technical, but it is important to understand what capital stacks and waterfalls are because ultimately, as a passive investor, this is going to determine how you get paid and when you get paid. So before we dive into more detail on those two items, Travis is going to let us know why we are talking about this topic today.
Sure, Theo. Yeah, this, to your point, is a more technical topic. We don't always dive in to technical topics. So I thought this would be good to discuss. This is also a blog, on joefairless.com. So just wanted to kind of cover this verbally for folks. So, it's important to understand capital stacks and waterfalls, both from a passive investing perspective and also from an active perspective. So I want to highlight a couple different things, the difference between a capital stack, a waterfall. I'll have you cover probably some terminology just to paint the picture a little more broadly. And yeah, really, what are we talking about? Like always, as an investor, we're talking about risk. This has a lot to do with risk. This has a lot to do with due diligence, vetting a deal, being comfortable with what you're investing in. So I'm excited to dive in. And I guess before I take it away, did you have anything else you wanted to add, Theo?
Nope, let's get into it.
Cool, man. I'll start with just kind of discussing the waterfall here from a high level. So the way that the capital stack works, which we'll talk about in a minute, is, it's often referred to the waterfall. So waterfall is how cash flow trickles down and gets distributed, right, to the investors, to the GPs, et cetera. So what's important to note is that the waterfall is outlined in the PPM, the private placement memorandum. Every passive investor needs to be reading the PPM. You could obviously leverage an attorney, a lawyer to help you out with that, but it's very important to understand all the ins and outs. There could be a lot of things in those that are unfavorable, that you may not be comfortable with. So definitely be reading those. So what the waterfall really covers is who, how, and when each partner, we're talking about a limited partner or a general partner, gets paid from the performance on this particular real estate syndication that we're talking about. I don't care if we're talking about multifamily or self-storage or mobile home parks. This is about syndications, right? Real estate private placements. So some share classes, as an example, may only receive cash flow. Others may receive cash flow plus equity upside, and so we're going to talk about that. So the question is, up front, I always talk about knowing your criteria, knowing yourself, knowing your goals. Are you more cash flow focused? Are you more equity focused? Maybe are you a combination of the two? Do you kind of like that 50-50 mix or whatnot? So it's also important to note that common equity and preferred equity, which we'll define here in a minute, they're not debt. So cash flow gets paid out after expenses and debt on the property are paid. Okay, so more on that in a bit, but Theo, I want to turn it over to you real quick just to cover a few definitions and paint the picture a little more broadly. I'll jump into the capital stack in more detail here in a minute.
Yeah, so just to kind of follow up what you said. So for the waterfall, when you're in the PPM, it's kind of written out in paragraph form. So it says, first this happens, and then after, assuming that there's cash left over, then this happens, and then assuming there's cash left over, then this happens. Then in the PPM you'll see it for they may call it different things, but like ongoing cash flow, and then how the cash flow at sale is distributed, right? And so,
Yep.
but at the end of all of this, right, the money that you're getting from the waterfall is going to be calculated as a certain return to you, and the two common return factors that are used in multifamily syndications and really any syndication that I've looked at is the cash on cash return, and then the IRR. And so as the waterfall plays itself out, all of that cash flow that you received, is the cash on cash return is going to be based off of that and how much you invested. So, super simple numbers. If you invested $100,000 and then you received $10,000 in cash flow from the waterfall, then the cash on cash return is going to be 10%. The other return factor is IRR. And so it's a little bit different than cash on cash return because IRR is going to take into account the timing of those distributions. So cash on cash return is kind of absolute. Once the waterfalls has played itself out, all the cash flow that you've gotten divided by your total investment is cash on cash return. IRR is a little bit more of a complicated. It's a pretty long formula, but basically it takes the time value of money into account. So if you receive that $10,000 in 1 year or 2 years or 5 years, the actual value of that is a little bit different because the value of money in 5 years is different than the value of money today. And so unless you're investing in like a deal that's held for like a year, then the IRR is going to be a little bit lower than the cash on cash return. The way I like to think of IRR is a really good comparison tool to compare multiple investments to see how they're absolutely performing, because cash on cash return might not be a good indicator because of the fact that maybe you get like no money up front and then a bunch of money at the very end, which would look the same as getting that same money spread out, day one and then at the end, and then nothing at the end. So I think IRR is a metric to look at. And then another important, not really a metric, but just something to think about that we've talked about on the show before is the velocity of your money. And this is another reason why IRR is so important, because the sooner you get that money back, not only is it worth more, but it's also able to work for you more. So you can reinvest that back into another deal and make a faster return, as opposed to getting that money later, waiting a year, multiple years before reinvesting that. So those are kind of some of that's basically the output of these waterfalls. And so you really want to dive in to see when you're getting your money back. Not necessarily the order, but when you are getting it. So for example, if there's some sort of like preferred return or a coupon offered and it's not hit, right? So it's not hit year one. When does that accrued money get paid out? Because if it gets paid, because the timing of when it gets paid out will definitely impact that IRR. But just there's something to keep in mind ultimately, that you want to understand when you get paid, how much that's going to be, because you can better plan for when you're gonna get that money back and be able to reuse it to invest in other opportunities.
Yep, well said. Great points. So let's get a little more technical then. I want to talk about the capital stack. I want to define a few things with different tier classes, IRR hurdles, splits. So this is the technical portion. For those that know me, I'm not the most analytical person, but I think this is important for the episode. So the capital stack in a real estate syndication is basically where the debt and the equity partners are ranked in order based on the relationship between risk and priority. So let's define that. So the highest priority in the capital stack usually holds the lowest amount of risk. So the classic example here is your senior debt. This could be Fannie Mae, Freddie Mac. This could be a private loan. This is the debt on the property, the mortgage, right? You could think about a single family home, your mortgage. So usually those returns, as far as thinking about the lender or the bank, are quite low, right? They could be 2 to 4%, let's say, for example purposes. That's a pretty low return, but they're in first dibs, first position, first lien, this kind of stuff, right? So they have the top priority. Then depending on the structure, not every syndication obviously is going to have preferred equity, but I want to talk about that a little bit. So preferred equity has first dibs on distributable cash flow, okay, after the debt service has been paid. Okay, so this could be outlined different ways. What I've seen commonly is that preferred equity may have just a nice solid, cash flow return, call it a 10% or a 13% or a 12% cash flow, maybe no equity upside, but again, they're first in line after debt and expenses are paid on the property. And back to the definition real quick. cash flow is distributed after expenses and debt get paid. So they would be just under, your senior debt there. All debt always has top priority. This is the same too. Again, we draw parallels all the time into the stock market. Same concept. When a company goes bankrupt, a publicly traded company, let's say, the debt gets paid first, right? And then it's the equity holders and the shareholders. If there's money left over, then they get paid. So that's just how it works in business. So then below preferred equity, if that's even part of the equation, then you have common equity. And this is what most limited partners are investing in is the common equity. Okay. And so, you might participate just in cash flow, or you might be participating in cash flow and equity upside in a deal. And so I want to talk about that a little more in detail, because you can have different common equity share classes. You could have A class and B class and C class and so on of common equity. And I'll give you the example that a lot of folks are using nowadays that I see in the multifamily space. They'll have an A class and a B class. We've talked about this before on the show. So if the investor's more looking for cash flow, maybe a higher yield, maybe a higher preferred return, that's commonly your A class shares. So you might receive, for example purposes right now, you might receive like a 10% coupon or a 10% preferred return, but you're not participating in equity upside, meaning if the property was purchased at $50 million and it later sells at $60 million, you're not partaking in that upside, that $10 million gain. There's no part of that. You're just getting a flat 10% return, assuming that the property can produce that. And then the B class would be participating in cash flow as well, but sitting lower in the capital stack. So you have your senior debt, you have your preferred equity, if that's part of the coin, then you have common equity, which is your A class, and then common equity B class. And so they might be receiving a little bit lower cash flow. Let's call it a 7% coupon or preferred return for example purposes, but then they are participating in any potential equity upside in the deal. In that same example where the property was purchased at 50 million, sells at 60. So then there would be usually a split. And so I want to talk about splits for a minute. So a split means a split of the equity or the cash flow between the limited partners and the general partners. Okay. So let's say the split is 70-30, just to use a pretty common metric that a lot of firms use. So it could be that after the preferred return, let's talk about cash flow first. So after these B class common equity limited partners receive their 7%, and assuming the A class and preferred equity and everybody else has made their money, there'd be a 70-30 split. So every percentage point over 7 is split. 70% goes to the limited partners and 30% to the general partnership. Same thing with equity. In that example of 50 million purchase price, 60 million sale price, there's $10 million there in equity. So a 70-30 split would suggest that 70% of that 10 million or $7 million gets sent to the limited partners pro rata based on everybody's, percentage of ownership in this particular deal or fund. 30% or $3 million goes to the general partnership. Okay. So that's what a split means. The numbers will vary. You might see a 50-50 split, a 70-30, a 60-40, an 80-20. And that's just what they're talking about when you talk about splits. And so that's important to recognize, obviously, for obvious reasons. You want to know how favorable that is. And to take it one step further, this is all part of the fee structure, by the way, and vetting out the deal and deciding how comfortable you are, is to consider that there could be an IRR hurdle as well to further complicate this. So it might suggest there might be a clause in your PPM or in your waterfall that suggests that after these B class limited partners, common equity, get, let's call it a 15% IRR, internal rate of return, then the split changes. It was a 70-30. Once you achieve a 15 IRR, now it goes to a 50-50 or a 60-40. You know, there's different ways to structure all this. It's just, as Theo pointed out earlier, it's just important to review, and it's usually laid out in paragraph format. Like you said, you know, if this happens, then that happens. Once that happens, then this would happen, you know? And so you're just kind of reading through this in story format to kind of read between the lines and then see what would ultimately happen in all these different scenarios. So it can get quite complex. That's why it's always good to leverage a legal team if you can, if you have the resources to do so. If not, just really study up on the PPM, just really understand what it is you're investing in. General partners can structure all different kinds of ways. I've seen everything from the most simple 70-30 split across the board. There's no hurdles, there's no prefs. It's just 70-30. Every dollar that gets made is 70-30. And then I've seen very, 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 very complex structures that are really tough, even for some legal attorneys and lawyers to figure out. So just be comfortable with it is kind of my bottom line. And yeah, hopefully that was informative. And Theo, thoughts on that or anything that we've talked about so far?
Yeah, one thing I would say is it can get very, very complex. Especially just hearing it. And so if you go to joefairless.com, we have an accredited investors category. And there's a lot of things that Travis has talked about, you know, understanding the different types of splits and cash return versus IRR, these hurdles he talked about, you know, what's the difference between preferred return and cash return, right? All these, well, we've got long blog posts that go into a lot of these things. But yeah, the whole point here is usually when you're presented with, you know, an email from a syndicator, you just see what the projected or forecasted return is. And so this is kind of the behind the scenes, how that number was calculated. To make things even more complicated, you also have to think about there's also something called a catch up, like a GP catch up.
Yeah.
Because, you know, let's say, for example, in this, let's say there's just a straight up pref offer to one group of 10%, let's say, and the deal only cash flows 10% the entire time. And the GPs technically haven't gotten any of the profit split yet. So as a sale, they catch up to make things even based off of whatever the equity split is. So 70-30, and then the rest is split 70-30. And then I also want to mention, so for the hurdle, so IRR is going to be 0 until you've gotten your money back. And so this hurdle, it usually just comes into play at sale, unless there is some massive refinance. The profit split shouldn't change during the actual hold period. So it'll be more like the $10 million profit at sale. The first $5 million is split 70-30, and then that happens to bring you to that 15% IRR, and then the next $5 million is split 50-50. But ultimately, right, this is important to understand the behind the scenes, because it helps you understand where that money's coming from, where the return factor is coming from. But at the end of the day, what really matters to you is, are you comfortable with that return that they're offering? Are you comfortable with that structure? Are you comfortable with when you are paid compared to when everyone else involved in the deal is paid? And so, I mean, and you need a really good example that we talked about before the show about, you know, something that seemed like it was very favorable to the GPs, but it was actually, you know, you got a return that you're comfortable with, so it was fine.
Yeah, I'll share that story really quick. I was a limited partner in a deal, in a syndication type offering, and the general partners in this particular offering were taking 66% of all profits and leaving approximately 33% to the limited partners, which is what I was. But when all was said and done, when we exited that deal, you know, I had around a 15% IRR return as a limited partner, even though they took that much in profits. And so I was okay with that. You know, as a limited partner, if I could get a 15% return all the time, I'm good, you know? So I was comfortable with it myself. And this was a little bit different business model. This wasn't your typical multifamily syndication kind of deal, but it just made sense to me, but not everyone would be comfortable with that. Some people would look at that fee structure and say, absolutely not. There's no way I would do that. And that's fine. We're all different. But to me, that met my criteria. So yeah, we always talk about vetting the team and the market and the deal. This whole conversation we've had today is about vetting the deal. And it's some of the more technical analysis that would go into that. And as Theo pointed out, we have tons of resources. This to me anyway, me personally, if I was listening to this episode today, I would need a visual. I would need something to actually look at and to study and to read over paragraphs. And I would have to go pull out a PPM and I would have to read through what you're talking about. But hopefully it added some value for those that can just envision what we're talking about and just some things to jot down to be on the lookout for. So cool, man. That's all I got.
Yeah, a good visual would be, why it's called a waterfall. Just think of like a waterfall that starts at the top, right? That's the cash flow, and then it hits that first, whatever ridge, and then whatever water is left, that once that ridge fills up and it gets what it gets, then the remaining falls into the next ridge, and then the next ridge, and the next ridge, and then at the end, what's left over goes to the last person. So just think of it that way. I think that's where the terminology came from, like a multi-tiered waterfall with all the cash flow getting split between the different levels. So yeah, definitely check out our accredited investors category on our best ever blog. That'll be very helpful if you're more of a visual learner. So Travis, anything else that you want to mention before we sign off?
I don't think so. Just do your due diligence, as we always point out. That's it.
Perfect. Well, thanks again, Travis, for joining us today. As always, best ever listeners, thank you for listening. Have a best ever day, and we'll talk to you tomorrow.